Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, June 28th, 5:06 p.m. Eastern Time. Coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Market state, we're in an uptrend. You can see over here on the trend gauge, we've got bullish slash uptrend. Very nice green arrows flashing for market leaders and for all three time frames that we track the five major indexes against. That's the short-term 21-day, medium-term 50-day, long-term 200-day. Green arrow means all five of the indexes are trending above these benchmarks. We still have the red stop sign for NASDAQ 100 as it remains excessively extended from its 50-day moving average, I believe by 7.4%. 6% is the outside of normal, and all we seem to do is pull back to that 6% level, and then some strength comes into the NASDAQ 100, which is what we saw yesterday. Just does not want to weaken, and if you're in those names, that's good for you. So what happened today? A little bit of a gap down, weakness before the market. S&P gap down 0.25%, NASDAQ gap down 0.4%. Went sideways for about 40 minutes, and then some very nice strength came into the market, carried us up to 40.90 after opening around 40.65-ish. But then shortly after noon, a 30-minute very harsh uh, 0.75% sell-off hit, and it hit fast. And I don't know if it was related to Jay Powell. He's over in Europe speaking, but it came down, but it held the opening of the 30-minute range. That's something that we keep an eye on all the time. And then we just kind of chopped into the close. Ended up well, we basically regained the gap down in the S&P, slightly positive finish on the NASDAQ 100. So let's look at the numbers. RG8, this reflecting that leading stocks continue to act very well, led by FFTY and ARKK. Our RG8 composite up 0.75% on the day. S&P 500 just barely down 0.04%. NASDAQ 100 with a nice turnaround, but still off the lows, but also off the highs. Gap down 0.4%, was up as much as, I believe, 0.8%. Still got a green close, up 0.20%. But anytime you see strength in this, you're at risk of a rug pull because of how extended the NASDAQ 100 is. And on top of that, we had weakness in semiconductors today because of some government threatening to limit AI chip sales to China. But despite that overhang, NASDAQ still put up a green number. Dow down 0.2, mid caps just barely negative. Russell 2000 small caps up 0.47%. Global diversified 60/40 up 0.10%. Bonds doing the job today. Bond prices higher across the board, yields down slightly. In-house GROTECTION, our flagship portfolio, up 0.23% on the day. Some nice numbers by some of the stocks that we own. As leaders continue, as I said, to hold up well, we're focused on leaders. Leading stocks in an uptrend, that's the recipe for good performance. And then, of course, protecting the downside, depending on where you stand versus the various moving averages and the action in the individual names. So here's the S&P 500. You can see, let's draw you're seeing this formation across a bunch of names. Basically, the declining tops trend line, this represents the pullback that we saw in the S&P 500 and the NASDAQ 100 and pretty much every leading stock. That downtrend broken yesterday, digestion day today. Absolutely nothing wrong with this. As I mentioned, what you want to watch now is that the 21-day moving average is catching up with the low of Monday's action, which was the end of the 5 out of 6 day sell-off. That's the key level that we need to stay above. That means that, the uptrend that we had and then the pullback that we had, The pullback stopped at that point, and we're resuming the upward bias. You can see the slight hook up now in the stochastics. That's a positive thing. So, uh, I mentioned in yesterday's video an inflection point yesterday that turns the prior day's lows into the level, the key level to look at, and that's not just for stocks, that's for indexes also. So here's the Nasdaq 100, pretty similar move with that declining tops trend line, and again, 21-day moving average now has caught up to the lows of Monday. Good level to trade against. You got the hook back up on the stochastics. That's a positive. Can't complain about that. And from a price standpoint, still 7.5% from the 50-day. The 21-day only 2% extended from there. That's a quite a reasonable number. So that really means the meat of this move in here is when we separated from the 50-day. And as these prices from 10 weeks back come off, this should accelerate higher and catch up to price. Let's take a look at the Dow Jones Industrial Average. Uh, Also broke that declining tops trend line, but see relative strength still nowhere to be found here. But we are holding above the 50-day moving average. Haven't had a hook back up on the stochastics yet either. But that looks fine. Not as good, obviously, as the S&P and the Nasdaq 100 because it's more of a defensive index. Let's go to mid caps. Midcap's flat today, but you can also see that broken declining tops trend line back above the 21 EMA. Tight range today, hook back up in the stochastics. So 4 out of the 5 indexes have that move back up into the stochastics, only the Dow being the holdout. Declining tops trend line break also on small caps. Second close above the 21 and a higher high. That's good stuff. Relative strength also showing this week after some serious relative weakness the prior 2 weeks. So again, that 180 being a key level, and really even we would want the 21 to hold on a pullback. We've got a position in TNA, which is the 3 times IWM. So those are the 5 major indexes. Next thing we want to look at is the dollar. What did the dollar do today? Well, the dollar was strong, still below the 200-day moving average and still in a tight range, trapped between the 200 and the 50-day for about 4 weeks now. Let's flip to the VIX. VIX making down again today, down 2.3%. Not closing lows or not new lows, but we haven't made new highs on the index either relative to that. But we are still riding below that 21-day declining moving average. That's a bonus for bulls. Back to the dollar. What did precious metals do? Well, dollar was up, and yeah, precious metals were down. Gold making a lower low, breaking below the bottom of the base. GDX gold stocks making a lower low and now breaking the 200-day moving average. Not good there. Not good at all. Don't need to be in these right now. Stocks are acting just fine. We don't diversify into underperforming asset classes just for diversity's sake. That's like buying rotten vegetables to say you have a balanced diet. Doesn't make any sense. Silver down, has held the 200-day moving average. Let's go to Bitcoin. A lot of noise over the weekend and earlier in the week. Down slightly today, 1.8%. Note the volume on the move up days in Bitcoin now resting basically for the last 3, 4, 5 days. Tight little range there. That's good. Resting before normally with a bounce off of here, you rest and then you continue the trend higher. We'll see if that stays in effect. Now let's flip to bonds. Broad bond index. Look how tight bonds have been between the 200 and the 50-day moving average. Broad bond index up 0.32% today. TLT, the long bond, up 0.4%. Note the alerts that we have signaling a breakdown or a breakout of this tight range right around all of these moving averages being stacked up. That's what happens when you're in a tight range. Yields, TYX, the 30-year, down 1%. Again, a tight range, especially over the last about 2 weeks, sitting on the 200-day moving average. And the TNX, the 10-year, down 1.54%. Again, a tight range above the 200-day moving average there. So those are that's the inter-asset correlation that we hit in every video. Here's the tail of the tape. You can pause this if you want to read through it in detail. Stochastics, let's get rid of that red arrow there. They've improved. They've also improved on the RG8, so let's get rid of that arrow there. NASI, McClellan Summation Index, still down, but slowing its rate of descent. We need that before we flatten out and turn back higher. Dollar neutral, in range on rates. Tomorrow we'll have the AAII bullish bearish percent update. VIX, as I said, down fear and greed, up a little bit. It's showing extreme greed. Still not concerned about that. We need this to be over 90, I would say. Operating under the bull case, some news. Powell said back-to-back hikes are not off the table. After the close, the Fed said all 23 banks passed their stress test, meaning if a recession happened, would their capital be sufficient? The answer was yes. Let's see if that lights a fire under banks tomorrow. Let's also keep an eye on whether or not that fades, because we've been keeping our eye on banks and real estate as possible shorts, since they are definitely lagging the S&P 500. Day count from up one to up one with a consolidation on the S&P. Second day back above the ADMA. 23rd day above the 21-day moving average. 18-day rally since the breakout. Still concerned about how extended we are versus the 50-day moving average, but holding within the ranges on the S&P and the NASDAQ 100, above support and resistance, below resistance. You can see the leaders and the laggards for today. I didn't point this out when I went through the agenda, but the charts today are going to focus on non-tech strength. I got two sectors that are somewhat related, that are two of the strongest sectors right behind the big three tech sectors, being XLC, XLK, and XLY. We'll see some interesting tickers when we look in there. So what do we do in-house? Sold Meta. So one of the things we wanted to do is get out of Google Meta and Microsoft, with the NASDAQ 100 being as extended as it was. Those three are big holdings in the chat ETF that we have a small position in. Wanted to lighten the number of, after they've had some outperformance. We booked the Meta, the gain was 25%, which is almost 3 times the index during the holding period. So we met our goal there. We always try to, when we buy something, our plan is for it to do 2 times what the S&P is doing, at least 2 times. So we took that off the table, and we added 2 leaders, SMCI and MDB, on strength today off of a breakout. You'll see this when we get to the charts. And we also added the SOXL. I mentioned the government restricting sales of AI chips. NVIDIA came out late morning and said this is not, even if it's implemented, it won't, our demand is so strong that it wouldn't impact our results. After that, we bought Soxel. We're down slightly on it. But the bottom line for today, early strength, harsh noon sell-off, then we chopped into the close. But leaders, if you just looked at the leaders list, you would have thought the indexes would have been up a half to a percent. Leaders continue to outperform. That's good stuff here. Our buys actually increased our adjusted beta to the highest it's been since this rally, 2.29. That's relative to a 1.0 for the S&P 500. And that means, basically this means if every stock that we own would be up its ATR on the day, that's the outperformance that we would expect to see versus the S&P 500. Obviously, not every stock is actually, it's 80% of its ATR, which doesn't happen. But this also means the same thing on the downside. It's a risk measurement as much as it is wanting to know how much we can make. We're also concerned with how much we could lose. Let's go to the charts now, and let's start off with the changes, the buys that we made today. Here's the semiconductor index, SOX, pulled back, hooked back up yesterday on the stochastic after holding the 21-day moving average, a familiar setup. As I mentioned, the break of the declining tops trend line. We didn't buy it yesterday. We bought it today on the pullback, pulled back to the ADMA. And, this bar doesn't even look like there's any issue with the government's uh, restricting chips. So, nice, easy stop on this too. The 21-day moving average on the SOX will be our stop on SOXL. We sold Meta, taking advantage, selling into strength is what we did on this, taking the 25% gain. And then what did we buy? We bought MDB, big volume early after a really nice 3-week consolidation after its earnings gap up, floundered in the afternoon with the sell off in the market, closing right below the 400 level. We bought it just above 400, so we're down slightly on this. And then the other buy that we did, SMCI, after pulling back, two closes below the 21, recapturing it. The volume was there for the move. Light stochastic hookup on the daily. Right off the 21 is where we bought this. This one we are up on as it performed nicely the way we wanted it to. And with that daily hookup in the stochastic and where it is, the risk to reward is definitely skewed in our favor. So now the sectors that are basically number after the big three, XLC, XLK, and XLY, two sectors that are not tech related but are performing very well. And let's start off with uh, the industrial sector, which is one of the sectors that's part of the 11 that make up the S&P 500 and making new highs, breaking out of a base, making new highs. Let's look at a weekly chart on this. Not quite to all-time highs, as the indexes aren't to new time highs also, but making highs relative to late last year and early this year, a good sign. You can see the relative strength recently here, and this kind of kicked off on 6-2 with this move back above the key moving averages off the 200-day moving average. And let's look at a couple of stocks in this industry that are acting pretty well. First of all, one that we own, Caterpillar, showing a cup and handle here. We bought it off the 8. It pulled back to the 21. It's been up the last 3 days. Some good action there, and plus good action in the sector, which we always want to see. A couple others that are looking great but not fantastic. Honeywell, flat on relative strength, but it's got a big weight in the XLI. If it moves, it'll certainly help. UNP, Union Pacific Railroad, trying to get back above its 200-day moving average. Boeing is in there. Failed breakout, pulled back to the 50-day moving average. Pretty decent setup there. GE, the leader in the industry, not from a market cap perspective, but from a relative strength perspective, as just what a run this has been on, looking very nice. John Deere making a comeback again with that 6-2 gap up day, back above its 200-day moving average, putting in a little bit of a handle here. Now let's flip to another sector similar to IYT. They've got quite a bit of overlap, but transports. Cup and handle breakout the last 2 days. Transports. Do transports act well with a recession looming? Remember, the market looks 6 months down the road. IYT. So let's take a look at a couple, the biggest holdings in here. And the biggest holdings aren't necessarily the best looking stocks. UPS is the biggest holding. This very obviously has room to go. Union Pacific is the second biggest. We already showed that. One that we own, Uber, third biggest holding in here. And this just continues to act fantastic. Airlines, 2 big days back to back. Here's DAL, the fourth biggest holding in there. You can see the breakout there. Fifth size rating is Old Dominion. Look at this chart. Looks like a tech stock. Boom. 2 big days up for Old Dominion as the transports have had 2 nice days there. And FedEx initially sold off on its earnings. Look at how it made higher highs after this supposedly not good earnings report, breaking out of this flat base. So some good news there with some non-tech sectors, XLI Industrials, IYT Transports. Nice to see strength broadening out, and it's not just tech. And anybody that says it is, tell them Don said it's not, and then show them these charts. That's going to wrap it. As always, like to hear from you. Email don@revereasset.com or my partner Dan Stewart, dan@revereasset.com. Phone is 855 Real Wealth. That's 855-732-5932. 2 days left in the second quarter. It's been a great month for leaders as well as the indexes. And always, though, a reminder, it's not how much you make in the market, it's how much of that you can keep. It's nice to be able to rack up some gains after protecting capital last year. And that's our process here at Revere, flagship portfolio GROTECTION. Grow your assets when the market is healthy, protect your assets when the market is not. And that'll wrap up Wednesday, June 28th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.